Okay, let's dive into this. Welcome to today's explainer, where we're going to make the leap from casual, long-term investing to the incredibly fast-paced, fascinating world of active trading. If you've been, buying index funds and you're wondering how the day-to-day split-second action actually works, well, you are in exactly the right place. Today, we're popping the hood on the stock market to look at the mechanics, the strategies, and of course, the risks that define active trading.
Here is a quick roadmap for what we'll be building today. We are going to cover the stock market engine, navigating the bid-ask spread, day versus swing trading, reading the charts, and finally, managing your trading risk. We'll take you step by step from the basic mechanics all the way to professional risk management.
All right, Section 1, the stock market engine, how trades actually happen. Let's demystify what's going on behind the scenes. So you click buy. What actually happens next? Historically, you might picture those chaotic trading floors, right? People in brightly colored jackets shouting prices and waving pieces of paper at each other. But today, the modern electronic exchange is a pure, incredibly precise vehicle of supply and demand. It's a digital marketplace where millions of transactions are handled automatically. You set your price, someone else sets theirs, and when they meet, the market moves. Let's look at a super simple example to see how this works. Imagine you want to buy 200 shares of a company. Let's call them Delicious Lemonade PLC. You look at the market and decide, okay, I'm willing to pay £100 per share. First, you register that interest, and that goes onto something called the order book. Next, the exchange's matching engine automatically searches the book for a seller. Now, it might not be a perfect one-to-one match. There might be one seller offering 100 shares at £99 and another holding out for £101. The matching engine is incredibly efficient. It can literally combine those two sellers to give you your 200 shares at an average cost of £100 per share. That combination and execution is what actually creates the final trade. But what happens if there just aren't enough natural buyers and sellers at exactly the same time? Enter the market maker. These are financial firms that act as crucial invisible middlemen. They provide constant supply and demand by sitting on the order book, just constantly quoting prices they are willing to buy and sell at. This ensures liquidity. Because of them, you don't have to wait hours for a perfect match. You can trade your shares instantly. Moving on to Section 2, navigating the bid-ask spread, the cost of doing business. This is the hidden engine of the market, and it directly impacts your wallet. Now, market makers don't provide that instant liquidity out of the goodness of their hearts, right? They do it to profit. And the crucial concept here is the bid-ask spread. Every single tradable security actually has two prices at any given moment, not just one. The bid is the highest price a buyer will pay, and the ask is the lowest price a seller will accept. The gap between them, that's the spread. So here is the golden rule you absolutely must remember. Whenever you want to buy instantly, you pay the higher ask price. Whenever you want to sell instantly, you receive the lower bid price. This means on every single transaction, you lose the spread. It's an immediate cost, an invisible tax, even on those so-called commission-free trading platforms. And this spread, it isn't static. You can think of it like surge pricing for liquidity. Market makers demand more compensation when they face higher risks or uncertainty. If a stock has really low trading volume, or if the market is highly volatile, market makers widen that gap to protect themselves. This also happens during pre-market or after-hours trading. Spreads can be 10 to 20 times wider there. They'll also widen the spread to protect against information asymmetry, which is just the risk that they're trading against someone who knows something they don't. So how do you protect yourself from these wide spreads? Well, you use limit orders. See, a market order basically just says, get me in right now at whatever the ask price is. A limit order, however, draws a line in the sand. It tells your broker to execute only at your specified price or better. Using limit orders is a massive, absolutely crucial strategy to control your execution prices and keep that invisible spread tax from eating away at your hard-earned capital. Section 3, day versus swing trading, finding your style. Let's figure out what kind of trader you actually want to be. Choosing how you trade depends entirely on your personality, your risk tolerance, and frankly, how much free time you have to anxiously stare at a screen. Day trading is super high intensity. You're holding positions for minutes or hours, aiming to capture small price movements, often using high leverage up to 4 times your initial capital. The risk is high because you have to act incredibly swiftly. A single loss could wash out your whole day's profit. Strategies here include things like scalping and riding immediate momentum. Swing trading, on the other hand, is for the slightly more patient trader. You hold for days to weeks. The leverage is typically lower, around 2x, and the risk is a bit more moderate because the trade actually has time to mature. Swing traders rely heavily on technical analysis like Fibonacci retracements or the T-line to find longer-term trends.
Section 4, Reading the Charts, Technical Analysis Basics. Now, what's really interesting about this slide is how we start using visual data to predict future price movements. If you want to find those trends, you have to speak the visual language of the market, the candlesticks chart. Unlike a simple line chart that just gives you the closing price, a candlestick gives you a whole story of the battle between buyers and sellers over a specific time frame. A green, or bullish, candle shows the price opened low and closed high. The red, or bearish candle shows it opened high and closed low. And those thin little lines coming out of the top and bottom, those are the wicks, and they show the absolute highest and lowest prices reached during that exact period. When you string those individual candlesticks together, you start to see patterns emerge based on historical data. This brings us to support and resistance. Support is essentially a price floor, where buyers historically step in to stop the price from falling any further. Resistance is a price ceiling, where sellers typically step in to push it back down. Notice the magical moment in technical analysis. When a stock finally breaks through a resistance ceiling, that old ceiling often flips and becomes the new support floor. Spotting these flips is exactly what technical traders live for. Finally, Section 5, Managing Your Trading Risk, the ultimate safety net. This is the most crucial part of today's explainer. Look, all of the chart reading in the world is not going to save you without this final step. Why is risk management so absolutely vital? Because research shows an astonishing 70% to 90% of retail intraday traders fail over a sustained period, and it's almost always due to bad risk management. To survive, professionals vigorously advocate for the 1% rule. This means you never, ever risk more than 1% of your total trading capital on a single trade. For example, if you have 500,000 rupees, you never risk losing more than 5,000 rupees on a single setup. This ensures that even if you hit a terrible losing streak, say you take 10 losses in a row, you still have 90% of your capital perfectly intact to fight another day. But let's be real. How do you strictly enforce that 1% rule in the heat of the moment when your adrenaline is pumping? You don't rely on willpower. You use a stop loss. A stop loss is an automatic mechanical order to sell a security when it drops to a predetermined price. It removes human emotion from the equation entirely. If the trade goes against you, the system automatically pulls the ripcord, happing your loss precisely where you planned it. And this brings us to the beautiful math of long-term profitability, the risk-reward ratio. The secret is, you don't even need to be right most of the time to make money. If you use a 1-to-1 ratio, sure, you have to win 50% of your trades just to break even. But if you strictly enforce a 1-to-3 risk-reward ratio, meaning you risk 1 unit of capital to potentially gain 3 units, you only need to be right 25% of the time to break even. Think about that. Any win rate above 25% makes you a profitable trader. So, as we wrap up this explainer, I want to leave you with a final thought. The masses out there think trading is all about having a crystal ball and picking the perfect stock. But the professionals know that true trading success relies far more on disciplined risk control. The tools are all right there waiting for you. Limit orders, candlesticks, stop losses. The real question is, will you let strict risk management become your ultimate trading edge? Thanks so much for joining me on this deep dive, and keep learning.